Welcome to Investing Insights. I'm your host, Ivana Hampton. The 60/40 portfolio has proven it's here to stay, but it can benefit from a refresh like other classics. The total portfolio approach refines the 60/40. It takes a closer look at the components of the plain vanilla portfolio and considers how risky they are. The goal is to help investors stay disciplined as market conditions change for the better or worse. Jason Kephart has written about the total portfolio approach. He's a senior principal of multi-asset strategy ratings for Morningstar. Welcome to Investing Insights, Jason.
Thanks for having me.
Awesome. So what is the total portfolio approach and what makes it similar and different from a classic 60/40 portfolio?
So it's kind of a different way of thinking about building a portfolio. With a 60/40 portfolio, that's the classic 60% stocks, 40% bonds. You're thinking much more about like what things are. And with the total portfolio approach, kind of the nuance to it is you're kind of thinking about how things behave and what their risks are. And not all stocks and bonds have the same risks. So this is a little bit more of like trying to be more intuitive, I think, about constructing portfolios.
And this portfolio splits it into two parts. We have growth on one side, we have stability on the other. How would you define each of them? And then what market environments are they suited for?
Yeah, so I think like when you're thinking about the classic 60/40, that's kind of what you're trying to achieve anyway, right? Like the 60% in stocks is there for growth and the 40% in bonds is there to kind of add some stability. And, most people can't deal with the drawdowns stock markets have. We've seen 50% drawdowns, 20% drawdowns. For a lot of people, that's hard to stomach. So that's why the 60/40 kind of makes a lot of sense. But with the total portfolio approach, you could kind of think more about like outcomes like growth and stability. You could also really torture it as much as you want and think about things like equity beta, duration, but maybe growth stocks have some contribution to your duration target. So you're kind of measuring things a little differently, and that's really the nuance there. But with growth, you're trying to look for things that will kind of make money in good economic environments. And with the stability, you want things that are going to add some protection when things aren't going as well.
And let's stick with growth. Stocks are one of the investments that would appear here. What else, Jason?
I think anything that has like risks that are tied to the economic cycle. So you think about things like high yield bonds, private credit, crypto. These are things that have a lot of like potential downside risk when things go bad. And so putting those in the 40% of your like fixed income bucket, like maybe that's not going to, make your portfolio as stable as you want it to be. And I think the worst thing that can happen to someone is when there is some kind of drawdown in their portfolio, if it's more severe than they thought it was going to be, that's when I think people make mistakes and sell too early.
And you just mentioned high yield bonds, and I want to go a bit deeper because generally it's in that 40 in the traditional 60/40 portfolio, yet you've written that will not be the case under the total portfolio approach. Explain why.
Yeah, I think you'd almost do a little halvesies, a little bit in growth, a little stability, because there is some economic risk in high yield bonds. That's why they're higher yielding than investment grade bonds. And we've seen, pretty consistently that when stock markets really have tough times, that's when high yield credit spreads tend to widen and you see losses there. And if it's in the 40% of your portfolio, you're going to have a bigger drawdown than maybe you're willing to stick with. And obviously the goal of any portfolio is something you can live with through the market cycles. Because I think the hardest thing is staying invested. So if your portfolio is going to have too many hiccups because you're loading up with like things like credit risk in what's supposed to be the safe part of the portfolio, that might not be worth the trade-off of kind of maybe boosting returns because you have that more risk.
Something to consider. So there's the stability sleeve. Bonds would be an obvious choice here. What kind of stocks might be better suited for stability rather than growth?
Yeah, and again, you don't want to like go all in, but I think just thinking about like what is the role in a portfolio for any strategy, and you think about things like dividend growth strategies. These tend to be much more stable companies, or like a lot of the low volatility factor ETFs we see, and they're not always going to be like really good risk off investments, but they should hold up better than maybe the more risky growth stocks or small cap stocks. So just being mindful about that and saying, well, if I'm going to have some of these lower risk equities, maybe I fund a little bit of that from like the stability bucket and give myself a little more flexibility with like high yield credit on the other side. And so you could kind of end up in a 60/40 in the same way, but you're just thinking about it a little differently.
It's time for show and tell, Jason. So we have a chart on the screen showing a 60% growth and 40% stability portfolio. Listeners, we always got you in mind. Click on Jason's article in the show notes to see the graphic. U.S. stocks are paired with high yield bonds and U.S. core bonds with cash. How would this hypothetical portfolio generally behave in a market downturn and upswing?
Yeah, I think in an upswing, you're going to actually give up a little bit of the upside just because you are funding some of the stock portfolio with high yield bonds. So they're going to have probably a lower return over time. But because you're also funding it from some of the fixed income, that'll give you some extra returns. But what it does, instead of just funding the high yield bonds from the 40%, the stability, that's going to you're going to have less drawdown risk in general over most market environments. So it's kind of like a Goldilocks approach.
And the total portfolio approach comes with its own set of challenges. What are they?
Oh, yeah, there's a limitless. You could really make it as complicated as you want because you could really measure the past performance or risk of anything in a million different ways. Like, thinking about, large cap growth stocks in 2022, we saw very sensitive to interest rate changes. So maybe there's some duration in there, but you could really measure anything and kind of set as many factors or targets or outcomes as you want for the portfolio. And I think that's also a challenge. Like you can make it overcomplicated. And the other thing is things won't always behave as they have in the past going forward. So you could think something's safe or think something's risky, but the market environment maybe changes it a little bit. So you don't want to overly rely on past performance to kind of color your instruction. But if you're thinking just intuitively, these riskier credits when the economy's slowing down, that's a bigger risk they're going to pay back their money than something like an Apple bond.
Good reminders. California's public pension fund recently adopted the total portfolio approach. What other plans are adopting this strategy and could momentum build here?
Yeah, I think anytime CalPERS does something, people pay notice. So them announcing that they're moving to that shift later this year is definitely, I think, caught headlines and caught a lot of attention, but it's not a brand new approach. There are firms like American Funds and their multi-asset portfolios tend to think about things in growth and income and much more outcome-oriented and less about whether it's a stock or bond and more about how it actually behaves. So there's also things like risk parity. Alt managers have kind of thought about this way of bucketing portfolios by factor exposures. So it's not entirely new, but I do think when you have big pension funds kind of making moves, to usually get people's attention. And I think there are, even though there are complications with a total portfolio approach, I think there are some useful things that everyone can kind of take away from it without having to go full on overboard.
So let's go from big pension funds to everyday investors. How can everyday investors retool their investment portfolios to implement this strategy?
I think it's just about being much more mindful about the role something will play in a portfolio, why you're adding it. Is it there to play offense? Is it there to play defense? Is it somewhere in the middle? And then kind of allocating to it accordingly. Just following kind of a strict 60-40 guideline without thinking about the risk involved. That's probably not the ideal way to go about things. Although what we've seen is 60-40 has been pretty durable if you just stick to really basic U.S. large caps and like a U.S. aggregate bond type fund. But I do think, you can be more mindful if you want to add things like private credit or high yield bonds and crypto, and just recognizing that these are not kind of your safe havens. And if things go really bad, if you get a deep recession, there's going to be risk there that you're not going to see in things like U.S. treasuries and investment grade bonds.
So Jason, what's the takeaway about the total portfolio approach versus the 60-40?
I think the 60-40 is not broken, but that doesn't mean it can't always get a little polish. And I think applying some of the concepts of the total portfolio approach to your own portfolio can definitely make your portfolio a little bit more resilient and hopefully help you stay invested over the long term.
Jason, thank you for coming to the table and discussing how to build a smarter 60-40 portfolio. You have to come back now.
I hope so.
Thanks for tuning in to Investing Insights this week. Here's what you need to know before you go. Get your documents and your investments in order this tax season with Morningstar's annual guide to tax planning and IRA resources. There's a link in the show notes. And next week's episode of the Longview podcast will feature PitchBook's principal analyst on fund strategies, Hillary Wick. I want to thank senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor of Morningstar. Take care.